A chill has settled over China's economy. Headlines shout of a slowdown, and the world is starting to listen. The $18 trillion machine, once the engine of global growth, has begun to sputter. This is not a crash, but a grinding halt that feels just as dangerous. Official announcements have tried to calm nerves, but for ordinary people and global investors, the signals are impossible to ignore. Factories stand idle. Apartment blocks lie unfinished. Young graduates search in vain for work. Across China, the mood has shifted. The optimism of the past decades is fading fast, replaced by uncertainty and anxiety. The question is no longer if China is slowing, but how deep and lasting the slowdown will be. On paper, China still looks strong. The country's gleaming skylines, bustling city centers, and impressive infrastructure projects all seem to tell a story of unstoppable progress and economic might. From the outside, it appears that China's growth engine is still running at full speed, powering ahead while much of the world faces uncertainty. In 2025, officials reported GDP growth of just over 5%. This figure was proudly announced at government press conferences, with officials highlighting it as proof of China's resilience and continued rise on the global stage. The message was clear: China remains a pillar of stability in a turbulent world. That's much higher than in most developed economies. Compared to the United States and the European Union, where growth has slowed to a crawl, China's numbers seem almost enviable. International headlines often point to these figures as evidence that China is outpacing its Western rivals. But dig deeper, and the cracks begin to show. The headline growth masks a reality of desperate measures. Behind the impressive statistics, there are signs of trouble. Empty construction sites, deserted shopping malls, and unfinished apartment buildings hint at deeper problems lurking beneath the surface. Much of the expansion comes from state-led infrastructure and government spending. Massive investments in bridges, railways, and highways keep the numbers up. But these projects often serve more to create jobs and boost short-term growth than to meet real demand. Meanwhile, private business investment and household spending have lagged far behind, raising questions about the sustainability of this growth model. Official data is tightly managed. Analysts debate how real the numbers are, given the lack of transparency and the government's strong hand in reporting. Many outside observers, and even some within China, question whether the statistics reflect the true state of the economy, or if they are carefully crafted to meet political goals. Many say the numbers are more a target than an honest reflection of the economy's health. While the government insists the slowdown is under control, the numbers hide more than they reveal. The focus on meeting official targets can sometimes lead to creative accounting or the postponement of bad news, making it difficult to know what's really happening on the ground. Beneath the surface lies a story of falling confidence, weak demand, and mounting risk. Ordinary consumers are spending less, businesses are struggling to stay afloat, and uncertainty is growing. The official growth story may look impressive, but for many in China, the reality feels very different, and the future remains uncertain. Property has long been China's economic backbone. For years, families poured their savings into apartments, confident values would only climb. Now, that confidence is broken. Housing prices are falling in cities big and small. The property slump reaches far beyond real estate agents and developers. Construction, steel, cement, furniture, and household appliances all feel the pain. When people lose faith in property, they spend less everywhere else. Local governments depended on land sales for much of their income. Those sales have collapsed, leaving budgets in crisis. Developers, unable to repay loans, have stalled projects and left homebuyers angry and stranded. The bursting property bubble is a slow-motion disaster. It is dragging down confidence, sapping local government finances, and threatening the banking system with bad loans. China's central bank has injected huge amounts of money into the banking system, but the banks, wary of risk, are simply parking the cash. Real demand for loans is weak. This is a classic sign of lost confidence. Businesses hesitate to borrow because they doubt future profits. Homebuyers stay on the sidelines, fearing more price drops. Even with cheap loans available, people are not biting. The government has urged banks to lend more to small firms and households, yet each month, new lending figures disappoint. Companies would rather pay down old debt than take on new risks. This credit trap is dangerous. It shows that pumping money into the system is not enough. Without belief in the future, no one wants to borrow or invest. China's factories once hummed with activity and energy. Now, many are running below capacity, with production lines slowing down. Export orders have softened, and domestic demand is weak, leaving warehouses full. Factory surveys show growing pessimism among managers. Inflation, too, has vanished. Prices for goods are barely rising, and in some cases are even falling. This hints at deflation, where falling prices create a vicious cycle of weak demand and lower growth. For workers, this means wage growth is painfully slow. For businesses, it means squeezed profits and less money to invest in the future. The government is worried. Deflation is hard to fight, and it usually signals deep-rooted problems. The weak inflation data is a warning sign. It shows that the engines of domestic demand are stalling, and quick fixes are unlikely to work now. China's trade surplus remains large, and it continues to be one of the defining features of the country's economic landscape. Exports still outpace imports by a significant margin, with Chinese goods flowing out to markets all over the world. This has helped keep factories busy and ports bustling, reinforcing China's reputation as the world's manufacturing powerhouse. But the reason behind this surplus is not all good news. While exports are strong, Chinese consumers are spending less at home. Retail stores and shopping malls are seeing fewer customers, and domestic demand for goods and services is noticeably weak. As a result, more goods are being shipped abroad simply because they aren't being bought at home. This trend is a clear sign of weak domestic demand, not just export strength. When local businesses struggle to attract shoppers, it points to deeper issues within the economy, such as uncertainty about the future and a lack of consumer confidence. At the same time, the job market is under significant pressure. Many people, especially the younger generation, are finding it increasingly difficult to secure stable employment. The competition for jobs is fierce, and opportunities are limited. Youth unemployment is at record highs, with many young people unable to find steady work after graduation. This has led to growing frustration and anxiety among young adults who are struggling to start their careers and build their futures. This situation creates social stress and, honestly, holds back consumer spending even further. When families are worried about job security and income, they tend to cut back on purchases and save more for uncertain times ahead. Without strong job growth and rising incomes, consumer confidence cannot recover. Businesses hesitate to invest, and the cycle of weak demand continues. Wages are stagnant, and more families are choosing to save rather than spend. This cautious approach to personal finances is understandable, but it also means less money flows back into the economy, slowing growth even more. The government has launched various efforts to create jobs and stimulate the economy, including job training programs and incentives for businesses. However, so far, these measures have not been enough to reverse the overall trend of weak employment and sluggish consumer activity. A trade surplus can often be seen as a sign of economic strength, showing that a country is competitive on the global stage. But in China's case, it is also a symptom of internal weakness. Consumers are not buying, so producers must look abroad. The challenge now is to restore confidence at home, so that China's growth can be balanced and sustainable in the years ahead. China's stock markets have definitely been volatile. Foreign investors are pulling out, worried about weak growth and policy uncertainty. The yuan has lost value against the dollar, even though the central bank has tried to shore it up. To calm nerves, the government has actually ordered state banks and funds to buy stocks. The central bank has pumped liquidity into the system. But honestly, these are emergency moves, not signs of real confidence. Despite all this, the private sector remains pretty cautious. Big foreign companies are holding off on new investment plans, and even Chinese entrepreneurs are moving money abroad, looking for safer returns. The market's mood is, pretty clear. Without strong, sustainable growth, no amount of official intervention can restore lost trust. When you step back and look at all the signals together, a clear and unmistakable pattern really does begin to emerge. It's not just a collection of isolated data points or random headlines. There's a story unfolding in the numbers, the markets, and the daily lives of people across China. China's economy isn't collapsing overnight, but it is definitely under severe and growing strain. The signs are everywhere, from the skyline shrouded in uncertainty to the worried faces on the streets. The sense of unease is palpable, and it's not just among economists or investors. It's something ordinary citizens are starting to feel in their daily routines. Slow property sales, weak credit demand, sluggish factories, and falling prices all point to some pretty deep structural problems. The real estate sector, once a pillar of growth, is now struggling to find buyers. Factories that used to hum with activity are now eerily quiet, and retail spaces sit empty, waiting for tenants who may never come. These aren't just temporary setbacks, they're symptoms of bigger, underlying issues. The government's response, pouring in money, buying up assets, and propping up markets, just can't solve the underlying issues. While these measures might provide short-term relief or calm the markets for a while, they don't address the root causes. The deeper problems require more than just financial band-aids or quick fixes from policymakers. Real recovery is going to need renewed confidence, private investment, and stronger domestic demand. It's about restoring faith in the future, encouraging entrepreneurs to take risks again, and making sure families feel secure enough to spend. Without these, any rebound will be fragile and short-lived. For now, these fixes are only temporary. They might patch up the most visible cracks, but the foundation remains shaky. The risk is that, without real reform, these problems will only resurface, perhaps even more severely. The risks are building up: bad loans, local government debt, and hidden losses in the financial system. Banks are feeling the pressure, with more overdue loans piling up and employees growing increasingly anxious about the future. The financial sector is carrying a heavy burden, and it's not clear how much more it can take. These could actually burst into crisis if confidence keeps eroding. If people start to lose faith in the system, the problems could quickly spiral out of control, leading to a much bigger crisis that would be hard to contain. The challenge is deep and complex. It's not just about fixing one sector or tweaking a few policies. It's about rethinking the entire economic model and finding a new path forward in a rapidly changing world. China can't just go back to the old model of endless building and cheap exports. The world has changed, and so must China's approach to growth. The days of relying on construction booms and selling low-cost goods abroad are fading fast. The economy has to adapt, or it'll face even greater stress. The choices made now will shape the future for millions, determining whether China can overcome these challenges or whether the pressures will continue to mount, putting even more strain on businesses, families, and the entire financial system. China's slowdown, honestly, matters far beyond its own borders. Global supply chains rely on Chinese factories. Commodity exporters count on Chinese demand for oil, metals, and food. Investors everywhere watch China's markets for signs of risk. The drop in Chinese demand has already hit global prices for copper, iron ore, and energy. Countries that sell to China are, well, really feeling the pain. Fears about the yuan are rattling currency markets from Australia to Brazil. Multinational companies are rethinking their China strategies. Some are moving production elsewhere, worried about rising costs and falling demand. Others are pulling back investment, just waiting for signs of real recovery. The world is watching. If China can't stabilize, the consequences will be felt in boardrooms, factories, and stock markets across the globe. China's $18 trillion economy has reached a crossroads. The bubble may not have exploded overnight, but it has certainly burst. What remains is a slow, grinding adjustment that could last for years. The government's efforts to stabilize the situation have bought time, but they haven't restored real confidence. Until families and businesses believe in the future again, growth will stay sluggish and risks will keep growing. Will China's leaders find a way to spark a true recovery? Or is this the start of a long, painful transition to a lower growth era? The world is watching and waiting. One thing is certain: the days of unstoppable Chinese growth are over. The future will be more uncertain, for China and for the world.